Welcome to Money Masters. I'm in conversation with Samir Arora of Helios. Welcome, Samir.
Thank you, Ji.
Let me start with investment philosophy and strategy. You have consistently advocated for a long-term approach, and how do you determine whether a company has the long-term, very basic question. Because what has happened right now, everybody starts questioning and
So I think that
What's going
long term is a series of short terms. That means say 2-3 years at a time. Because my first belief is that not only you cannot know enough about companies, but the promoters of companies also don't know, or the CEOs of companies also don't know about their own companies. My recent favorite examples are that the founders of Google, Sergey Brin and whatever, Larry Page, these guys wanted to sell Google for $1 million to go back to doing their PhD. And they offered it to Excite. That means they did not know that Google can become like this. The Netflix founders went to Blockbuster Video and wanted to sell Netflix to them for $50 million. So the Netflix guys didn't know that this will be worth 400 billion. The Blockbuster guy didn't know that Netflix will be worth 400 billion. The Blockbuster guy also did not know that his own company will be worth zero in a few years.
They will not be Blockbuster anymore.
So the point being, if promoters and managements don't know, how are we supposed to bet on management for long? So we say you take 2-3 years at a time, and basically it's easier to analyze companies in that horizon. Of course, if you know something seriously that this sector is being disrupted, but next 2 years are good, then don't do it. But I'm saying in most of the other sectors, in regular sectors, you won't know that it is being disrupted. All you're saying is, broadly they are okay. You look at it for the next 2-3 years. If they look good, then you look at it. Otherwise, don't give me a 10-year story. Because anybody who...
Nobody knows about it.
Not only that. Anybody who says this is good for 10 years, basically means he was not clear to say it was good for 5 years. He needed extra growth, extra story. So then...
More time to justify.
More time to say the big picture TAM is very good and this is very good. So therefore, in that sense, 2-3 years works because the environment is the same. The market preference also is the same for certain kinds of things. And whatever, interest rates, same management, whatever. So we say long term in equities in general as a class. But individual stocks, say 2-3 years at a time.
2-3 years time.
Just one more quick example. So the example, I've owned HDFC Bank for say 25-30 years. And we told the management that we are not long-term investors in the bank. So what does that mean? When a result comes, we analyze it, or we attend the
take
call.
A stock of things.
Otherwise, if you're a long-term investor, why do you need to look at it every quarter? Mr. Buffett says, put all your eggs in one basket and watch the basket closely. Why should you watch the basket closely if you're long-term investor? You can say put your eggs in whatever basket and enjoy. But watching it closely means if something is going wrong, you have to take action. Which means you're not long-term. You are seeing it.
Your money could be invested for 50 years. That's a different...
But you are analyzing it, and because you find it okay to continue, you are continuing.
Your view on valuation. How do you decide when a stock is way too expensive and you won't touch it? Or you'll get rid of it? Or you'll sell it right away?
So the way we have defined it is that there are two kinds of stocks in our universe. One is stocks which offer reasonable returns, but with higher confidence. These are regular growing stocks, like say like Bharti or maybe HDFC Bank, ICICI Bank or some IT company, which are well known. They are not overly expensive at this point, because if they are overly expensive, like many of the consumer, we have already thrown them out. Now, these companies in theory are supposed to give you returns in line with their earnings growth. They were already well known at the start of when you bought it. And therefore, it's not that you are discovering them, you are choosing them. There's a difference between discovering a stock and choosing a stock. Choosing a stock, everybody knows, but your preference is a little different from another guy's. So here you are supposed to get returns in line with earnings. So if they grow much more on a year-to-year basis, then obviously in the beginning you will enjoy it because you are getting extra return. But over time you have to use that as a source of cash to buy something else. And then there's a second group where you bought it early, or you bought it when it was being discovered or IPO happened or something. There we hope to make higher returns, which means we call them reasonable confidence in high return. First one was high confidence in reasonable return. Reasonable return we define as basically 15-16%, assuming that the market goes every year 12-13% on long term. And if you grow 15-16-14,
You get something
you are reasonable return. But if you are doing something new, buying something small, buying something complicated on a bad day, then you want to make 20-25% return.
Yeah.
So there you will not sell it for 20-25% return. But one day that stock, if it does well, will become like our first group. Our most recent example for that is Varun Beverage, which we bought in 2019. It went up 10 times. But we used to call it reasonable confidence in high return. Now we call it high confidence in reasonable return. कि चलो ठीक है, now
It has been fairly
हो
valuable.
गया, आप discover हो गया. But still it is better than other consumer companies for whatever reason, penetration, ये वो, or going into.
तो उसमें dramatic growth का you don't see.
नहीं, अब वो आ जाएगा तो, but we can't expect it forever. So now if it grows 15-16%, then it's great if it can do that in revenue plus volume.
How do you do with, what do you do with those things that is a high conviction? You thought that it is the first category, good return, and then it's dragging. It's not,
So that is HDFC Bank.
Okay.
Is one example. But there
but it has been a reasonable return for a while.
And high conviction. We don't have high confidence in high return.
Okay.
We don't have that category. We might in our heart feel that.
Okay.
But our categories are high confidence, reasonable return, reasonable confidence, high return.
High return.
Because the theory is that you get high confidence when a company is already doing well. Therefore, everybody knows about it, or many people know about it. When you have reasonable confidence in high return, is because the confidence is not full because there is some twist. Suppose you buy Indian hotels after COVID. And now you can say, I have covered everything, but you haven't covered one thing, whether COVID will go away or not.
Yeah.
So I don't like all these arguments of people that we are waiting for a crisis. We buy in 2008 October and we are waiting for people to die and then we'll buy because we'll get it cheaply. Because the world cannot go on like this, that you will buy every 10 years only. And secondly, when people are dying, you don't know, you might be the next one to die.
Yeah.
So, वो extreme हो जाता है, but उसमें the outlook is not clear. So, if there are many factors, for example, we have 8 factors, evaluation, ठीक है, history, disruption, but one of them is outlook.
Yeah.
So, outlook is also one of the factors that whether it can handle this for 3-4 years, the crisis or not.
What do you do when you have these companies which are dragging?
We let them be for some time.
Acha, you hang around with them.
Because no, if we feel that it's okay and then it's not,
take a view.
What can we do? But if we know that it won't be good, then we will not keep it.
But
mostly the ones which are dragging are where you think they should not be dragging. They are dragging. Okay. But if somebody says they will drag, but they are very good long term, no.
Okay.
Our formula is 2-3 years. If we know, the problem is.
No, last time I spoke to you and you said that we normally have a 2-year cutoff time, and then we give up.
No,
but HDFC, you made an exception.
No.
And it turned out to be okay.
That is for our discovery of new things.
Okay.
I agree with you. What I meant was, sometimes you say there is something which we don't know. That, in HDFC Bank, we still say, oh no, this is because of this reason, that is FI selling, this reason is because wo merger ho gaya. So we are still trying to justify that we know. Sometimes you will not know at all. Then
quality of management in your making investment decision. How do you go about, forming more nuanced view now?
So there is no such thing as quality of management. If the stock is doing well, they are high quality. But the point is, in general, what is good corporate governance? What is good quality of management is only that the bad things are not there. The good things are very difficult to say that this is good or not. There should not be blatant bad. For example, when you are choosing between companies, there might be companies which have, for example, there's a big group in India, which according to me in the past used to offer massive, used to do massive warrants to the management. So one of these big companies of a big group of India did a management nahi, matlab owner, whatever it's called, warrant issue for the owner. And then the stock fell. Below that, first they could give only 10, they had to buy only, they had to put down only 10%, then later when SEBI made it 25%, that time it was 10. So the stock fell and they said we are not going through with the warrant issue. And less than 2-3 months later, they started a new warrant issue because now the price is lower because
Price
of, I
is
think,
gone.
2008 and all. So these kind of things we have in our collective memory in our company. Then there are companies where we think that the debt is being shown at a lower level by taking money from private equity, which is not equity. It is actually debt.
Pretending to be equity.
Because they will give a guaranteed kind return. So theoretically, you are buying
Debt.
equity. And theoretically, you're buying equity.
Equity.
But practically, it has a return guarantee of say 10-12% per annum in case equity does not do well. So things like that. So what I'm saying is the bad is easier to define. The good is basically the absence of bad. For example, if somebody says that this management is conflict free, it does not have private companies. Well, you're not supposed to have, no?
Yeah.
So it's great baat
Yeah.
kya hogi? That's what I mean. To say something is good management is a bit more complicated, and we don't need to go that
But basically, in 10 years of a company's existence, you figure out that, these guys will not
Because they've
become downright
they've executed well.
executed well, and they don't do something downright crooked.
Yeah. That's what I'm saying. So all these guys, but I'm saying it's just that in my definition, if somebody is not crooked, I don't have to call him good. It just means you're
not crooked.
Yeah. That's what I mean. How to say something is good corporate governance? But he doesn't do anything bad to shareholders. But if you don't do bad, that is what you're supposed to be like that.
Yeah.
That's what I mean.
Okay. You have been, operating.
By the way, if you want very good corporate governance, I have 2-3 examples, which we consider as not absence of bad, but good.
Great. Yeah. Okay.
So one of them was in those days, Eicher Motors in 2008. So I forget the exact thing, but Volvo was going to take a stake in Eicher Motors and buy the promoter's share because there was below some 9% they were buying or something. So instead of the management selling 9%, which was at a 2-3 times the price, the management said that every individual shareholder, every shareholder can tender shares and proportionately
realize the value, higher value.
So this was beyond normal. This was beyond normal.
Not just me. Everybody will benefit from this higher value.
And you get in proportion. So there was no requirement. No, people here sell to partners and don't let the market come in. Then actually the same thing happened with Max also.
Okay.
Then I forget, I think New York Life or somebody was selling, and because there was a deal that the exiting investor can partner can sell at a discount to the management. They said no, it's in the company. So the company technically bought back and then sold it to the new guy. So that time it was not
Axis thing.
Axis nahi tha, pata nahi jo bhi tha next. So then this was also done where everybody in this case was not directly getting, but it was coming in the company, the same company, and not bought privately by the.
It was not getting,
So some of them you get where you say, this is beyond normal.
Or this is a fair thing to do.
Yeah. In many others, it's okay.
How much of a threat are you witnessing from the emergence of the passive in India and there?
Yeah, that is a big threat in terms of, you can see it in valuation. So if you see the Indian AMC market caps and you compare it to global market caps of AMC companies, in India we have these, even though we also own, by the way, which is HDFC AMC in our portfolio. But HDFC AMC market cap is $10 billion. Wahan pe you see guys managing trillions of dollars, they won't reach $10-12 billion. Where I used to work, Alliance Capital, currently, I don't know exactly, but I think it has 700-800 billion or more under management. Its market cap is $3 billion. It's all because of passive.
It's all because of passive.
That's just the way it is. So I'm talking it as a business.
As a business.
But even actually in the market.
For an investor, is it really how long do you think is, are the days of active management numbered in India?
Well, we try every day to
justify your existence.
We even do hedge fund, which is like even more active. So right now we will see, but that is a longer term trend where the penetration of passives will increase.
Just asking about, there is one kind of mutual fund, which is like a PMS, which has been permitted by mutual fund to launch that mutual fund. That strategy.
Yeah, nobody's understood a word of what is asked. Or nobody has done it. We have also not done. Because nobody knows what it means. The only thing I can say, I have not even read properly because I don't want to be first in all these things. Let somebody do, we'll see.
Okay.
But basically what I understood is that if you are doing, say, a long short fund, your maximum gross can be only 100. So you cannot do the fund.
That
so
is
it's
not
a non-starter from the beginning only. Because that means if you do long 80, you can only short 20.
Okay.
Then your net might be 60. But you need that because you are playing there on how much your longs will do versus how much your shorts will do. Like for example, in our offshore fund, when we say we are net 60. Normal days we are long 120 and short 50, 60.
Okay.
So our gross is 180, which is long plus short. Then, वो जो 60% that we are short and 60 that we are long, उसके difference में you can make money.
Okay.
But otherwise, it will be totally dependent on the market. If the market is down, then your shorts will make money, your longs will lose money. If the market is up,
it will get balanced out.
Balanced, then you will never get full exposure. इसमें क्या है? Because compared to the 100%, the long only guys invested 100. I have invested say 120 and shorted 50, 60. So जो मैंने 20 extra long किया, that other guy does not have. So for that, if I can make on that extra long more than what I have done on that 20% short,
you still made money.
That you make money. Then you are left with only extra 20, 25 short that you have done. But that extra long that you have done and the extra short you have done, you can make money. You can write covered calls, covered puts. So usme you can make 1% more or so. That's how we are able to compete with the pure long only guy. Otherwise, if all your life you are at 60 net, how can you beat 100 because the market is generally up?
Actually, this part I was, difference between managing PMS, hedge fund and mutual fund. This was the first question.
So the thing there is, first of all,
explain me the approach.
In the end, the game is that you should know which stocks are good with whatever factors and which stocks are going to underperform the market. The rest is packaging.
Okay.
Like we go out to the world and they say, no, you are not a real hedge fund because we are what is called a long biased hedge fund. Because our net is normally 60s. So pure hedge fund game is 25-30 net. But then they are not trying to beat the market. They are trying to beat zero. We are not trying to beat zero. If the market is down, we'll be down as long as we are down less. And over a cycle, we want to beat the long only guy. But there are guys who say, no, we don't like that because that is a different bucket or a different decision maker. We want 25 net. हम कहते हैं, no problem. We will take these stocks long. We will increase the size of our shorts. We'll give you 30 net if you want. And we can test the last 10, 20 years what it would have meant. It would mean lower returns than our current. But what I mean is, in the end, these things don't matter. You should just know that these stocks are... Suppose somebody comes and says, which now nobody has said, but in theory they could come and say, because we buy 40 stocks, mostly on the long side. Somebody says, I want only 15 stocks.
Okay.
So we'll say, okay, from this group, we'll choose whatever, smallest 15, largest 15 if you want. And then you can sample it. You take our every month's portfolio. From that, we choose whatever is your requirement. You want only 15 concentrated small caps, which we don't approve, but you want it.
You want it.
Okay, we'll see if that makes sense to you. So every month, just take whatever are small caps and make that into 15 stocks. Means, unka jo bhi weight karke dekh lo. So what I'm saying is that mix and match is dependent on
what customers
so that's why in all these things it doesn't matter. People say, why are you doing a sector fund? I said, nothing. We have these stocks from these are from the financial sector. Our financial sector wala portfolio le lo.
It's just a subset.
It's a buffet type thing. You have to broadly know which stocks are good, which are bad, and उसमें आप market cap का कर सकते हो. Because somebody might you can't choose. If you are giving a general purpose solution, then you can't choose only all the small caps. All that little bit of balancing is required. Beyond that, we don't differentiate what it is.
How much of our opportunity, like I had this question when you're, among the first few funds, the one which followed the flexi cap was a banking fund. Financial services fund.
Because we...
Rather than a large and mid-cap fund or a multi-cap or, a more diverse offering.
Because that time, that finally we've done also. But the idea at that time was that we have to do what we believe in. Technically, when I am doing a flexi cap fund and you say, what do you believe in? I am not saying I believe in large and mid. I believe in flexi. But if I do financial sector, I believe in it because you can see it's my top weight.
Okay.
Right?
It was a top weight anyway.
It is still, and then also.
And it's a top weight of the Nifty in the
everybody,
Sensex too.
everybody. Then what has happened in that fund is there was a second level of thinking which we have said we will not follow. The financial sector index is totally bank heavy.
Yeah.
Like I believe 90% is in
banks.
banks. We said we won't do it.
Because that is cap weighted.
Let the benchmark be benchmark. We are mostly banks plus
NBFC
capital
and
market,
financial
NBFC,
services.
Yeah.
What is the difference that you are witnessing in running a PMS and mutual fund in
So
India?
first of all, I am not technically managing either.
Yeah, no, you
but as a business,
keeping an oversight.
As a business. So the very few PMSs which have become mutual fund guys get money in PMS. We still get. Because our PMS performance, if you see, including January, which was a bad month for everybody, 1 year, 2 year, 3 year, we are ahead of the index and ahead of all these big PMS, not the pure small cap guys who've done well, but generally done okay. So what is the difference? There's no other difference. Mutual fund is fun because you get money from the public, and sometimes you are amazed at which city this money is coming from and how did they discover Helios, and thank you for that. Mutual fund is little bit of that, at least maybe 40%. In PMS, every customer you have to strive for and get from.
No, but that is the magic of digitization in India.
Mutual fund is fun from that angle. Yes.
So you are not really missing. You think that it will be a non-starter because they can't really short freely the way
right
the new
now it
design
doesn't
and the
look.
new structure.
But I haven't properly read it. But these guys in Bombay have read it and didn't look that anyway.
Now tell me something about this. How do you generate investment ideas and some filters or
So as I said,
and sharing it among people or mentoring people.
So mentoring people is easy because in our top management, which is the head of the mutual fund, the head of the PMS, Dinshaw Irani, who's the CEO, and Abhay Modi, who's the head of research, all of them have been with Helios for 15, 18 years.
Okay.
So it's not that I am mentoring them. Effectively, we have grown together, except that I was the fund manager and previously these guys were analysts. So that is why everybody speaks the same language and everybody knows who is who. Otherwise, when there's a new fund and you hired 2 guys from this company, 2 guys from that company, nobody knows who's closer to Samir and who wants to be this thing or cut or play politics. Yeah, these guys have been around and happy for 18 years. In fact, Dinshaw and Alok for nearly 20 years because we started in 2005. So that everybody knows his this thing. And the new analysts that we have hired, now the primary mentoring is by head of research. But we have a call 3 days a week where the research guys present their ideas, where I also contribute. And then when I go to Mumbai, I meet them. But so far it's worked. So.
It's, informally structured like this. Sharing ideas, validating.
Sharing ideas, common research is common.
Research is common. How often do you reject these ideas?
No, so the thing is, the research is being rejected, research ideas being rejected at 2, 3, actually technically 3 levels. First level is that the analyst may himself reject it because now he knows what we want. Second is Abhay Modi, who's the head of research, will say, Nana, these guys will not like, I know them for 20 years. This idea will not like.
It won't fly.
And third is, in that group, whether you like it or not, the fund manager may say, I won't buy it. There are many stocks I don't buy. I say, no, I'm not buying. Somebody else may buy it a little bit here or there. So, वो तो हो जाता है. And main thing is that the analysts are being tracked on their performance. So it's not just that you recommended and then went away.
So effectively you have a research setup and then you have the portfolio manager who take it or reject it or use it.
But the thing is that because the research, in the research meeting where the analyst is presenting, first of all, it has been sort of pre-approved by Abhay Modi. That this idea, let's
it's
take
a tacit approval beforehand.
Let's take it to the group, and then he will present and say, I have this idea, and I may say no, or somebody else may say no.
How did this Zomato idea evolve when you were among the first few to really buy into it?
So Zomato idea, actually in the IPO, which happened at 76 rupees, we put in an order for $50 million from our offshore fund. That time, mutual fund was not there. And we got 1 million, I think, or even less because it was oversubscribed, so 50, 100 times. So then we sold it next day. See, when I am buying an IPO on my own, you didn't give me as an anchor or something. I don't care. Oh, one day you sold, you bought one day. That is my call. I don't owe anything to anybody. So we sold it.
No obligation,
No
yeah.
obligation. Even if you give me, then also no obligation. But then a little bit of obligation. Okay, you gave it to me and not somebody else. So it was, I think, 125 or 130 or something. Then the stock went to 170. Then at those days, the management was very, well, arrogant may be a strong word, but you can say arrogant. I can say, I don't. So they were sort of arrogant. We will not meet. We will meet once a year. They were buying other loss-making companies and all that, and nobody was interested. I used to see on my Twitter make fun of Zomato every day. Then Zomato stock fell to 40 rupees. That would have been, I don't know which year, September 22 or 23. And that day they said we are restricting our investment in other companies and we are capping our investment in Blinkit, I think at 900 crores or something. And we have this part of profitability. The stock went limit up from 42 to 52.
Yeah.
So we bought it next day at about 52, 53 rupees. Saying that we know the business, but that time nobody knew about this quick delivery and all. It was only food.
Only the food. It's like your Aisha and Enfield story. You bought it for something else and it Volvo.
But the thing is that people think that they are charging, 30%. I think it is very cheap. Cheaping on the stock. I am saying you are supposed to give, my dear. You are being saved from going out, pollution, traffic, time. And you have paid 800-900 rupees now for Netflix. When will you see Netflix if you keep going out for dinner? And then young people. And so 100 rupees or whatever is the average muta mati that you are paying, whereas they are only making 20 rupees out of it, is just reasonable for all the effort and time. And
do you think it's a sustainable business at these margins?
100% sustainable.
Okay.
100% sustainable. We're talking about the food is really big. First of all, there's no third guy also. So now it is there. It's become a high confidence, reasonable growth. The second part is now the quick commerce. So in quick commerce,
that's a bonus.
No, now it's not the bonus. Now it is the main. If it doesn't do well, then the stock cannot do well. Because now a major part is the quick commerce. So in quick commerce, the issue has become that we have a third guy. Fourth guy, we pata nahi, but third guy, Zepto. And according to me, Zepto has to back off because otherwise Zepto cannot go public. You cannot go public at peak losses. So if they want to go public in the next 3, 4, 5 months, they will have to at that time show that in the last 5, 6 months, we were, at this loss and then it declined a little bit and with volume declined a little bit and now in the next 6 months, 9 months, we'll be breaking even. They can't say we are at peak losses, but don't worry, one day we'll make money. They would have already done that according to whatever we can gather. That increase the size of the order for free delivery or give lower discount or something. You have to show.
You can't be a discounter.
No, you can't come in at peak losses. So, and you have how much money? Maybe according to us, 10, 12 months of money. So 10, 12 months of money means that if you're going to go public after 4, 5 months, then you'll have 4, 5, 7 months left of money. Okay. So that time, and you also have to hope that the market is not like this. Or suppose in that day, Zomato deliberately gives 10% discount. So that the rest of the guys buying the IPO back off, saying these fighters. You have to respect the big boss. So that is Zomato. So in 1999, I used to own Z. And the Z went up some 15 times that year. So that year, Kunal Dasgupta, he was the CEO of Sony. He was about to do an IPO. So he came to Singapore. I was the biggest Indian mutual fund manager. And he was saying, Z mein ye kharabi hai, Z this is bad, Subhash Chandra. I said, nah. Please put Mr. Subhash Chandra's photo on your mantle and pray. Because if his stock falls, you are not going public. And if his stock is high, you will get a 20% discount. You are going to get his valuation into 0.8 or 0.7.
He will be the reference.
He will be the benchmark. It's the same thing here. You hit Zomato down, you are not going public. You are not going public. Simple baat hai. So, let's see how it goes.
So how is the pace of investment ideas being generated right now?
So
the number of people and new ideas, or do you have these 4,000 companies, 800?
No, we are not into 4,000.
Of course, not 4,000, but 4,000 listed universe, and you keep getting something.
No. So for us, it is that there are some 500-600 companies, which is the 500 we have to follow, which is from our
BSE
500 index, and 25-50 because they're new companies, some IPO, the analyst followed in his previous job, something. So let's say 600 companies. Now our game is to reject companies based on 8 factors, and in theory, sometimes it's very confusing, but reject them on even 1 factor. Why it is confusing is, this company is bad management. That is also a fighting point or a debate. Is it bad management or okay management? Because we say that there should be no bad. But what is left does not mean it is good. It means it is not bad. That's what I keep saying. If corporate governance is not bad, doesn't mean I can say it's good. It's okay like any other company. Same thing with valuations. Every company, just because it is not expensive, does not mean it is cheap. So actually everything is a debate.
It's a relative
analyst
thing,
can propose, but we will say, nahi, yaar, this guy is not high. You compare like this, you compare like that. For example, in the Westlife used to make and still makes loss. So in theory, we'll say, in 10 years, it has not made any money. It is expensive. We say, no, it's not expensive, yaar. You have South and West for total less than $1 billion market cap. Look at a private equity guy funding something randomly. Kuch bhi benchmark bana ke, we somehow feel, okay, it's not cheap, but it's not to be rejected on valuation alone. So everything is being fought. So on that basis, you come down to about 250 type companies where nothing is bad. No, these the first factors don't include valuation. Those are factors of we don't like the industry, like these auto guys, or we don't like the strategy, or we don't like the business, or we don't like the management. And then you are rejecting that these are very expensive, or that their current 1 or 2 years numbers are very boring, like growing 3%, 5%, like these consumer type guys. Some of them may not be historically expensive, but for 5% growth, why are you waking me up from my sleep? So then we are left with about 100, 120 companies, which on our factors are not bad on any factor. Then we will see
it's a pass thing.
Pass.
That's your
then we are saying what is good. And not all the 8 factors will be good. That's another difference with the rest of the market, that we don't say that we'll buy good companies at good valuation with good history and good management and good outlook at good prices, because you're not getting. You can say we are buying good management and good history and good outlook, and the rest of it is okay.
Now tell me, one thing I came across on your website, or maybe your Twitter handle, that you were hiring some quant guys.
So we already hired one quant guy.
Okay, you hired one.
One already.
What is the approach? What is the thinking?
He was running a quant PMS.
Okay.
And now he needs some coder types.
Okay.
So the idea is we have no idea how this thing works. So this is exploration, not to do a product.
Not to do a product.
Maybe after 2 years, who knows? Abhi for us to say, what do you do and how can it help?
What's going on?
What is going on? How can it help? The current this thing. Because we ourselves don't know how can we do a product. First, the top 5 guys who are all oldie guys have to say, we understand what this means.
You have seen this 30 years of, being a fund manager, and you are mentoring a lot of people, or you are not mentoring.
No, I'm mentoring, but they are all
not directly.
No, but I am mentoring, you can say, because question to my puchto zyada, so mentoring hi ho gayi.
So in that sense. So,
by the way, we have a lot of summer trainees in Singapore. In the last 10 years, maybe 25, 30, who come for 3-4 weeks. That mentoring is more to teach them how to read books, because these are mostly young people.
How to read books?
How to read? I give them books to read.
We
talk about books, not how to read. How to read? I say, "Ye book padho, aur ek din baad we will discuss."
So it's
things and mentoring, like whether Google is a better business model or Apple is a, so dono ki book padho, ek mein bas books hain. So that is mentoring. Here, these guys who are coming in are a little bit trained. And so they are being mentored in the sense we are explaining.
मुझे एक फोटो भेजेगा उसका जो आपका जो बुक्स का स्टैक लगा हुआ है, जिसमें से आप जादू करके एक बीच में से निकालते हैं.
वो तो 2 घर में 2 ऑफिस में 4 हैं बड़े स्टैक्स. So what I mean is कि वो mentoring उसको मैं गिनता हूँ, इसको मैं गिनता हूँ कि these guys are working in some other sell side, this that. and we are only saying कि भाई हमारा style of stock selection is with this model.
Tell me, if you had to start, you have seen all these changes and this AI, quant, passive, these are very big, broader things about fund management. And, from coming from those days where, physical form and if you write an investor communication, that itself made a hell of
No,
a
that
difference,
time the thing was that we will give you this stock and you will get it in one clean certificate.
Yeah.
So you don't need thousands of signatures. That was
Signatures.
the highlight of life.
Yeah,
That you got, what is it called it? What certificate was it called when it was like a bulk? Like if you had 1 lakh shares in one certificate, what was it called?
Oh, that was a jumbo.
Jumbo.
It was jumbo, which is the dematerialization, because everybody had physical and we were migrating to, because it is all pre-NSDL thing.
Correct.
So jumbo holding.
Jumbo. So sometimes it was valuable.
Yeah.
Sometimes it was negative.
No, like today it is very difficult for me to explain to a youngster that there used to be something called odd lot.
Odd lot. My friend Samir, he made all his money in college by buying odd lots.
Okay.
Because odd lot used to trade at big discount.
Big discount, yeah.
Some 30%, 20% discount. So he would buy odd lots.
So, what would you do differently if you are starting today? Though you are still young, but...
effectively I have to do 30 more years, so I hope. So, what would I do differently? First of all, you have to be totally emotionally involved in this business. You can see who will be successful. Broadly. Sometimes, of course, luck might change. But what will I do differently? I don't know. Maybe I would have read these books before I started. Who knows? But no, don't know.
I don't know. Okay.
Generally, you do these things only whenever you start.
How do you remain excited about,
the same company?
No. About your, not company, about your work every day.
That's what I mean same companies and again and again.
No, but about the same work even,
Yeah, but I don't know. I can't do anything else. So that may be, I used to think a president of US, does he even know what S&P is right now? I used to think like that.
Okay.
So I'm totally into it. Nearly every minute, yeah. Including evening, I see US, by the way, CNBC, I see 1.5 2 hours. C means it's always on. And
sometimes
I have discovered that sometimes these guys chatting there is more interesting than Netflix and all. And YouTube is better than everything. Yeah. Like today morning, I saw an interview of, and this is morning in Delhi at 8 a.m. whatever, Tucker interviewing this fellow, अपना रे डालियो. अब कौन सुबह 8 बजे उठ के
वो सुनेगा.
टक्कर की वो देखता है YouTube में आई है नहीं. Very good.
That's a 1 hour conversation.
In Dubai.
Yeah.
So अब मेरे को ऐसी चीज़ मजा आता है.
This AI and quant-driven, is it really, you have any kind of impression of what is going to do?
No. So right now what we have done is we are saying कि for our 500 companies, at least यार देखें तो say what does ChatGPT Pro and all say about our companies and all. By the way, today morning, I asked, this is because I was coming here, I said to ChatGPT, OpenAI mein, is it for the next 2 years, is it better to invest in US stock market or Indian stock market? So after some great random analysis, it says Indian stock market with a 2-year view.
Okay.
So I said, are you doing this because you can see that I have asked this query from India? So it says, no, my things are based on some quant factors, not quant, some fundamental factors. And if you want, I can explain further. And it ended with a smiley. So this is better than anything.
Maybe it has recognized you, it is not from India. It is actually asking, responding to Samir.
No, basically this one I had not signed in. Because मेरा वो password उस वाले computer में, laptop में नहीं आ गया था. So it was not a signed in this thing.
Okay.
So it said, no, not dependent on the fact that you're asking this question from India. So I don't know what is the end game here, but it is a good tool for now. And let's see what it does.
You come from a background where, you'll be looking at new things emerging, EVs, renewable energy, AI. How will you be, do you consider this to be a thematic thing or something? Because it's going to be disruptive. It is almost like, Y2K.
Yeah.
When the internet was coming, it was changing the world, but nobody knew how. Now we have, with hindsight, we can say that
I have read a book called The Engine That Moves Markets. It was written by an ex-Templeton head of research. Very good book, you must read. And there are some, I don't know, 30 chapters, each chapter of a different technology, from telecom to internet to mobile to pata nahi kya kya, to originally shipping, railway. The end result is you don't know who are the winners, you only know who are the losers. For example, you know that if OTT comes, the multiplex guy is a loser, but you don't know who's the winner. अब तो पता लग गया कि Netflix बन गया, but say previously or among the Indian guys, oh Sony Live है कि Z5 है
नहीं भी अचानक मतलब जियो हॉटस्टार हो गया तो मतलब
वो भी हो सकता है. But what I mean is, in all of them, their point is that you knew who are the losers. So पहले, for example, you were transporting things via river and steamship and all that, and then the railway came. Now everybody was laying tracks. कोई न्यूयॉर्क to Chicago लगा रहा है, कोई न्यूयॉर्क to Boston लगा रहा है. So you knew that this is better. But whose route is better, whose network is better? But you know ये तो गया because the technology has changed. So you're not supposed to, in general, invest on the basis that this is a big
Which is a big you referred, the Templeton guy.
Yeah, that's what I'm saying. So there is no need for us to worry today that with solar,
What will
because
win?
for example, the solar guys in India are heavily protected. What if, and actually they should. Why are you protecting these three guys? Nobody should say that the Chinese guys have to import it. They have to say you make it.
Make it.
Then you are Indian. Is Maruti an Indian company or a Japanese company? For most part, either an Indian company or dividend le bhai. So like that, you can do in sectors which are not ultra sensitive, and then you develop the
That's
network.
an impactful sector.
And then you develop the ecosystem there instead of saying can't come in.
So this is your view. You will only guess the losers.
No, it's not my view. I think mostly that's the case.
Mostly,
but once in a while, we might think we have understood who knows.
Yeah.
I never said never. But mostly it doesn't work to try and identify on day one the winner. Yeah.
Now you have dealt with, a lot of individual investors directly in your PMS, meeting them, aspirations. And, what is the biggest misconception people have about, you as an investor?
Me as an investor?
Yeah.
No, I don't know. I don't come to that. They don't talk to me about these things.
आप मैजिक करने वाले हैं या कुछ?
नहीं ऐसे कुछ नहीं है. सबको पता है. हम अपनी पुरानी हिस्ट्री दिखा देते हैं कि देख लो जी हमारे रिटर्न्स फॉर 25-30 years and ले आओ. You can see it in any phase. And but there's nobody's going that depth in a 45-minute meeting.
Now I need to very initial question. What is one piece of advice for the individual investor today?
Individual
reasonably
investor
invested in equities
should focus on his job. The problem
not lose his job. Okay.
This is for 0.5% we are managing. No, why do you need to? So on ₹1,00,000, you know how much is the fee that a mutual fund manager is getting? ₹500 in a year. So आप उसको multiply कर लो. Average, I think, is maybe 5-6 lakhs. I don't think it was that much. So you are paying what? 200-300-400 rupees a month to manage, and you can use that money. You can use that time better. Now, in terms of market, so the big picture concept is you look at any period which is slightly longer, say 5-7 year period. Equities normally beat debt, and equities normally beat real estate. And therefore, you are not supposed to leave the market on a bad time. You can leave the fund and go to another fund. You can leave the stocks for sure.
But don't quit the market.
Because there is enough data. I have this book which I keep talking about called Triumph of the Optimist, which is not worth buying because it's only data. Because it's more like a professors of London Business School, but they had took data for 100 years for mostly European countries and Australia and I think US. US also has 200 years data. I have another book. And they then divided into 10 year and
blocks. Okay.
Just to say it's not got dominated by one phase. And every time broadly equity does better than debt by about 5-6% per annum. But it does not happen smoothly. That is why you are getting 5-6% per annum. Otherwise, if every year you get 5% more, कि भाई वहाँ 7 या 12 मिलेंगे, आपको मिलेंगे 12, but ऐसे करके.
It's not a 12-year yielding deposit.
Correct. But over life it will. Yeah. So therefore, once you understand that, then on a bad day you can say I don't like this fund manager, वो another fund, वो उसके नहीं तो उसमें जाओ जो करना है करो. You might make 11 instead of 12 by a wrong selection, but don't leave the market. Yeah.
Now, the final question. One piece of advice you wish you had received earlier in your career? Though I think you got all the good advice, you have been a very successful...
I had one advice which nobody gave me, that I moved to India in 1993. And I was working in Alliance US. If I had been in US, and if I had been a little bit successful, not this successful, but a little bit successful, it would have been a totally different game. It's a totally different game, because the scale there of how much you manage and become a hero for outperforming by some 2% per annum or 1% per annum. It's a different game. So, but I would not have done it, because that time I used to think bigger fish in a smaller pond. बट हमने लास्ट 6 साल में देखा यार, हम यहाँ बैठ के अपने ग्लोबल फंड में भी आउटperform करते हैं, तो मे बी दिस फॉर्मूला could have been done all our life.
All your life. Okay.
But ठीक है ना, we had so much fun here.
So you regret that?
No, I don't regret. I don't regret. Sometimes I just think, but I don't regret, because I've had such a good life here. So I don't regret. No. But I'm just saying, अगर बोलेगी, maybe that would have been more big scale, and that's okay. It's not a regret. We are done.
Thank you very much for your time, and such candid and insightful sharing of all the things that you have been reading, learning, and while investing. Thank you very much.
Thank you.